Now let's see here. We've got an example here in compensated absences for you. Well, what is given? So Margin Inc.'s employees accrue 3 weeks of PTO, paid time off, for every year with the company. Unused PTO rolls forward and, as standard, is paid at the current salary rate in effect at the end of the year. So, for example, like generally speaking in life too, if you rack up a bunch of vacation time and carry it forward to when your salary is increased and then you leave, well, you'll be paid out at the salary rate as at what you accrued it at. As of December 31st, year one, Robert Jones had earned a total of 8 weeks PTO and had taken 4 weeks of vacation. So Robert Jones is owed 4 because 8 minus 4 is how much left Robert Jones has. Robert's salary as of December year one was $600 per week. On February 8th, his salary was increased to $800 per week. Calculate the amount that Margin Inc. should carry as a liability for Robert's accumulated vacation time and prepare the journal entries recorded at the end of year one and when Robert takes 4 weeks of vacation in year two. Well, what is the accrued vacation? As we mentioned, Robert had 8 weeks by the end of the year. We're dealing with the end of the year and had taken 4 weeks. So we now have accrued 4 weeks, and the salary as of that time was $600 per week. So simply put, the accrued vacation on the company's balance sheet that they owe to Robert is $600 times 4 weeks. Simply put, just $2,400. Now, what about those journal entries? Okay, Margin Inc. would record the following journal entry at the end of year one. This is salaries and wage expense and salaries and wages payable. This amount is going to be for the $2,400 that we accrued. And why is that an expense? Because it's a payable, right? We owe it, we accrued it, we can reduce our liability once it's paid out, and it is part of salaries and wages expense, just like normal accrued time, right? Normal wages. So even if Robert's salary was raised in the next year, Margin would still record the liability at the end of year one based on the $600 per week salary, as the vacation was earned during that period. As I mentioned, even if your vacation is accrued during your current salary. So, if you earn it when you're making, let's say, $60,000 a year, and you work at the company all the way until you're making $120 a year, well, your vacation time will be paid out based on what your current salary was at that time. When the 4 weeks of vacation are taken in the following year, the additional expense for increased wages would be recorded to salaries and wage expense. So when 4 weeks of vacation, this is Robert uses the rest of these. Well, we are going to reduce our liability, right? We're reducing our liability for the $2,400. That eliminates it off the balance sheet. Awesome. Now, our other numbers, okay. Well, on February 8th, year two, his salary increased to $800 per week. So now we're paying out $800 salaries and wage expense for that 1 week, right? So Robert had that time accrued, and in year two, this $800 is going to account for his wages there. Total payout is $3,200 in cash.